and welcome to the supplement from Limbo week. That is the final week of the year, and I am going to bring you today hopefully something that closes the year off with a bit of style, and at the end some predictions for 2025, which I'm sure everybody's keen on seeing. So if you've listened before, you'll know that I like to start with a quote, and today's is: maybe heaven was innocence, limbo was ignorance, and hell was fiery illumination. That's from Kimberly Sabatini, the author. Now, before I get started in earnest, I want to urge you to get those tickets bought for the next Property Business Workshop. They're selling fast now as people try and organise themselves for the first few weeks of the new year. Thursday the 16th of January 2025, that's the one in London. And this time round, Rod and I will be covering productivity, planning and financial accounting and bookkeeping. Why? Because we constantly see property businesses struggling with appropriate financial reporting, accounting and bookkeeping, and making the same mistakes time and time again. This will help you get a complete handle on the financial performance of your company or group when you aren't at a level yet where you can afford a CFO or financial controller. Set up correctly once and then just iterate from there. As always, it will be an action-packed, content-filled day which will stand alone in helping you to advance your understanding as a property business owner. Now we're into the last few days of the early bird tickets. There's still a 10% discount on face value, live at bit.ly/PBWFIVE. So welcome to the supplement. I can't believe it's the last one of 2024. It's just amazing how time has moved almost in a distortionary way this year. But perhaps because of the multiple ways in which things have moved in the macro landscape, from looking good to going well to looking very bad, which of course is the best time to buy, to being bad or at least maybe just average. How will 2025 go? We've got no real-time market update this week, as the publisher of Chris Watkins' excellent real-time data is off until the 3rd of January. So invest that time saved wisely. All I can tell you is listings looked very, very healthy over the last few days, and there'll be plenty of phones ringing for the next few weeks as the rush to get the latest tax stamp duty increase gets well underway. Macro's always trickier at this time of year. We've had finalised Q3 growth figures, which fit nicely into the ONS quarterly macro report, which I'm going to take a peek at. Business investment figures, which were better than expected, but now we're looking backwards, so we're talking pre-budget here. And then the retail sales from the week before. And then we've got the gilts and swaps, of course. In terms of the growth figures, the previous write-up from a few weeks ago has not changed materially, so instead I relied on the ONS's quarterly economic commentary. Growth? Blink and you missed it. There wasn't any, just as we were initially told. No revisions. Real GDP per capita, a much better yardstick of how anyone is doing in the real world, declined by 0.2% in the quarter. The other ONS headlines from the revised report: current account deficit widened to 2.8% of GDP, mainly due to a higher deficit in goods trade. Labour demand also fell, lower vacancies, slower employment growth. But unlike the Bank of England, the ONS assesses that the labour market remains tight overall, which I must say looks more like my assessment, but there is a major issue with trusting the ONS data at the moment, which the ONS themselves have highlighted. Core inflation at 3.5 compares to 7.1 in the spring of 2023 in the medium term, and regular earnings growth was still at 5.2, now that the base effects of those COVID bonuses have fully played out. The real GDP was not only 0.2% down on the quarter, but also 0.2% down on the year. One more lost year to add to the lost decades that have reared their head since the global financial crisis. The similarities between Japan from 1990 onwards and from the UK from 2008 onwards are stark. There are differences, but not necessarily differences for the better in either direction. It's Hobson's choice. Savings ratio went back over 10% in Q3, reversing a downward trend, suggesting that people are more likely to save now there is an actual real return on their money, and also that people are saving because they're concerned over future economic wobbles. It's very difficult to measure which is the dominant force here, but savings in time of zero returns suggests that the latter outguns the former in its impact, although most economic commentators either disagree with this or they just treat the higher rate as a fact, without any real supporting evidence or without considering the fact that people are saving because they're concerned about the future. RHDI, real household disposable income, my favourite metric really to see how the households are getting on when it comes to rent, did not move in Q3 after some really promising steps forward in recent times, which was another shame. And there's a useful graph in the report which I replicated because it speaks to the difference between the Bank of England assessment of employment and the ONS assessment. They graph vacancies per unemployed person. As with all graphs, it blips around COVID, but if we ignore that and instead concentrate on the fact the number was relatively stable at 1.6, compare that to a post-pandemic market which has surely not yet quite found its level, we now have 1.8 unemployed people per vacancy. This suggests the Bank of England have a bit of a point, but then that's the trend, and then we've got the absolute number. That's still pretty tight, 1.8 unemployed people per job vacancy. Now, let's not forget the fact the labour market was already historically tight in 2018-19, where unemployment was at or around or below the 4% mark. So you can still see where the ONS is coming from with the tight labour market. There's no way it can be anything other than tight at the moment, but maybe tight and loosening is a better description. Definitely to be monitored closely in 2025. If you were betting, you would suggest the unemployment rate is going to go up, not down, in 2025, especially at the front end as we deal with bigger minimum wage, huge change in national insurance for employers. So, one more output for the interesting roundup. According to the Bank of England and Ipsos Inflation Attitude Survey, inflation expectations increased slightly in November 2024, with 1 year ahead expectations at 2.8 and 5 year ahead expectations at 3.4, short of any shocks, which of course there will be some, mild or not, we do not know. These don't look like silly predictions at all, and historically this is normally when you're getting people in aggregate and or companies as well to predict these sort of things. They tend to do a pretty good job unless there's a significant shock like a pandemic or a financial crisis or any a debt crisis or any of the other things we may or may not be dealing with in future years. So onwards with business investment. The provisional estimate for Q3 was 1.2% upwards, which got revised upwards to 1.9% upwards, which is good news in a sea of very average and disappointing macro numbers at this time. This put the year-on-year figure at 5.8%, which again is well above consensus and very healthy. You would of course expect things to decline from here, because this was pre-budget and even before pre-budget speculation really, but it can't harm economic growth over the longer term. What's at the level below this though? Where's this money being invested? Well, mostly in transport and buildings. IP products, computer products and other machinery and equipment investments are falling in comparison. Which vehicles for transport? Well, mostly aircraft, which is why you might not be seeing it as much as you might think. But vehicle rentals are also on the rise after taking a big hit during the pandemic, of course. So where's the bad news in this report? Well, of the G7 nations, the UK has either sat at the bottom or just ahead of Italy for the past 27 years of what the ONS or the economists call GFCF, which is gross fixed capital formation, perhaps best understood as whole economy investment, more colloquially. It's not a league table we want to be at the bottom of, but regardless of the colour of the administration, one we have been at the bottom of for 24 of the last 30 years, with only an Italian economy, often described as sick, beneath us on occasion. Rewind to the retail sales figures then. 0.2% up on November. Black Friday was out of this reporting period though. All the anecdotal data is that this Christmas has also been a retail flop, as the consumers keep the pencil sharp and keep spending for whatever the economic fallout of 2024's budget is going to be. So that puts us to retail sales up 0.5% on the year. Remember, there's no inflation adjustment in these figures, and it was clothing once again kept things very suppressed indeed on the figures. Online values fell significantly across categories, appearing to be tighter living costs, meaning that more saving than usual would be needed in the run-up for Christmas. 4.3% down on the month, 3.1% down on the year. Online sales being a real drag on face-to-face retail sales. Whether low-quality online products have worked their way into the market and forced people back to face-to-face, certainly happened to me anecdotally, or whether we can really consider that COVID still had a trailing impact on shopping behaviour in late 2023. I guess it's possible, but it's a bit speculative really. That leaves us with the gilts, and this is the least reliable week of the year. 2 bank holidays in the same week. Volumes are very thin, not much really happens, what happens isn't really reliable. We had a mega low last Christmas on the yields of 3.245%, which was an incredibly low print at this time for the 5-year gilt. This year, not so. We opened the week at 4.332 and had limited reasons to drift upwards on the yield to about 4.43 by the middle of Friday. We trickled around the 4.4 mark for most of the period. Monday's close called halt to proceedings at exactly 4.332% yield on the 5-year, and the swap closed at 3.981, just on the right side of that psychological 4% barrier. So that leaves us at 6% for limited company 5-year vanilla buy-to-let, and therefore 8.6% plus on my workings. I factor in a 30% cost of delivery, which is going to include maintenance, management, insurance, voids, arrears, turnarounds, all the rest of it, right? So I see 8.6% as a safe enough investment yield if you're looking to use 75% leverage and you want any sort of meaningful cash flow return as we go into 2025. That's where the numbers are at. Now, the 30-year gilt at a yield above 5.15 looks dangerously tempting. Frankly, an incredible yield, which will become a problem for institutions who need to take risk and receive a significant return or premium over and above that 5.1. For example, pension funds. At that sort of level, you can almost just park the fund in there and walk away knowing that your long-term obligations are solved. Please bear in mind, this isn't investment advice, and I'm talking about pension funds there and institutions, not individual investors who are trying to build, create and defend wealth. So, with the macro landscape brought to a close for the year, we can move into the final deep dive. 2 reports to bring the year to a close. Firstly, Hamptons December market update. I've been impressed with their efforts on the research front, producing some of the much more meaningful and accurate predictions. Their competition is limited, of course. Some of the larger names in property produce some utter pigswill. Hamptons led with some interesting news around discounts. The median discount in November 2024 that was secured was £5,000, which is the joint highest figure since the pandemic. The last time it was at that sort of level was November 2023. The average asking price secured in November 24, however, was 98.2% of the final asking price, and that compares with 97.9% in November 2019, which was relatively flat but a pretty typical pre-COVID market. 70.9% of sales agreed in November normally complete by April the following year, compared to only 58.7% in the average December. Flats are much less likely to complete in time due to the reliance on management companies to produce information packs. 54.9% for November and only 45.3% for December should complete by the deadline. Now, of course, some of that work is going to be pushed forward and concertinaed and front-loaded, but it gives you a rough idea as to exactly what's going to happen around the 31st of March. They spend some time pinpointing the real impact of the stamp duty reintroductions. Homes below $1 million. Well, homes above $1 million achieved 96.9% of their asking price on average in November, which was lower than the 98.1% for homes between 500 and $1 million, and 98.3% for houses below 500k, which of course is the majority of homes transacted, especially outside of the M25. There's a second report on the Hamptons site which I found intriguing as well, summarising the differences between the old stamp system, when you paid the full whack based on the final purchase price, to the slice system, where you pay the marginal rate on the marginal amount, the system that we use these days. This was the work of Gideon George Osborne, man of the people, not. His claim that was 98% of home purchasers would pay less, but the system would raise more from those buying more expensive homes. Very noble. This was because the very highest rate was moved from 7% to 12%. At the point where the long holiday introduced by Liz Truss, it was a 3-year long stamp duty holiday, or 2.5 year long, sorry, another famous stalwart of our previous government, dies off on April the 1st, 2025. The average mover will be paying £5,479 in tax to move house. This is a 170% increase on the 2014 numbers, an average of 1.8% of the purchase price, up from an average of 1% a decade ago, and now. So, at the 2 million level, the actual rate of tax will be 7.7%. Until 1997, the top rate was 1%, and it was marginally calculated on properties selling above £60,000. How things have changed. The average UK household moved during the 80s and 90s stamp-free. Definitive causation is hard to prove, which Hamptons do recognise. However, the correlation between moving from large houses, the downsizers, have seriously reduced their number of transactions, and there's got to be a selection of reasons for this, of course. George's promise was, once again, an empty one, although mostly thanks to fiscal drag, of course. The average London buyer currently pays 2.6% of the purchase price in stamp duty land tax. This will move from here to 3.6% after April the 1st, 2025. You do end up asking yourself, how far can this go? However, the average transaction across many developed economies has between 5 and 7% taken out of the pie, and so this still isn't that out of line with that metric, I suppose. What else could you do? Well, so many economic commentators detest stamp duty so much. A break for downsizers, or some kind of incentive, probably best done with a limited time window, with a chance of increasing that time window but no guarantee. So maybe 18 months or 2 years. So as a downsizer, which would have to be tightly defined, your next purchase of your principal private residence is stamp free, for example. But for real reform, you're looking to a property tax style system, moving from lump sums on moving to tax paid on a monthly or annual basis as per the USA. It would, under the current system, have to be distinctly different from council tax, I suppose. But this was all more good work from Hamptons and thought-provoking stuff. Let's also have a look at Zoopla's house price index for 2024, which was out this week as well. Their summary, well, a sustained recovery in housing sales in 2024. We did come from a low base in 2023. The year-on-year changes, December to December: 21% more buyer demand, 23% more sales agreed, 18% more new supply to the market, and a 10% increase in the stock of homes for sale. Sales pipelines are 30% bigger than this time last year. Good news for agents following a lean year in 2023, which saw lots of closures across the industry. Zoopla characterises it as a strong year for volumes with muted prices. They do seem married to their view that prices would fall slightly this year, even in the face of evidence to the contrary. Affordability does remain a constraint, although we're seeing a different sort of pressure here as well. Rents rocketing, buying will soon once again become cheaper than renting, even with a proper calculation rather than just a straightforward comparison between rents and mortgage payments, which is fallacious. The 6.1 sales agreed per agent on average throughout 2024 is the best number apart from 2021, the white hot market for the past 8 years and beyond. That's monthly, bear in mind, 6.1 sales per month agreed. Zoopla declares a gap of 3.6% between asking and achieved sales prices for December 2024. They also maintain prices are up 1.9% as of the end of November 24. That's quite a lot lower than what the ONS, Halifax and the Nationwide have said, but there we go. They also saw prices down 1.2 last year, and so they're somewhat vindicated by their small fall in prices prediction, or at least they think they are, anyway. But they note an increase in discounts achieved just as Hamptons do. Zoopla refer to the mortgage rate increases, which makes good sense, although Zoopla often overemphasise the effect that the mortgage rate has on transactions and negotiations. The bigger issue, in my view, remains to be the stress test, which is not necessarily moving at all as rates fluctuate. Remember, you're being scored at 8% by many of the high street banks, and that 8% has not necessarily been any lower at any point in 2024. So for those who love that stat, prices double every 10 years historically, you might be surprised to know that the average house price in London has only gone up 83% since 2010. So even London hasn't doubled in the last 14 years. Zoopla sees a 2.5% increase in UK house prices in 2025, their most bullish for some time, with there being a continued rebalance between prices in the south and the north, mostly due to relative affordability and higher interest rates, of course. The comparables to the 83% London capital growth figure, 70% across the south, 66% in the Midlands, and 56% in Wales. Zoopla has Northern Ireland only up 19% in those 14 years, Scotland at 30, and the north of England at 41. I'd be surprised if these were accurate compared to the ONS, although I don't doubt London being the top of the regions, but they won't be that far out of the ballpark, I'm sure. They do see, at Zoopla, less room for growth in higher value markets. I'm not sure that applies to prime London or super prime anywhere, to be honest, which is much more of a global style market and much more disconnected from the overall fortunes of the UK economy. Zoopla sticks with the explanation that mortgage rates, the economy and the labour market will determine housing market future in 2025. Now, I believe that wages are well correlated with house prices, but the availability of credit and the price of it, as set by the stress tests, and then secondarily by the mortgage rates, are the real drivers, since supply of the right sort of houses is bound to remain much lower than needed, without a doubt. bearing in mind how many housing starts there have been in 2024 or not. We already know what the delivery figures will be for 2025. We just look at 2024 starts. As with Hamptons, Zoopla produces some of the much more credible and useful research in the industry, and whilst I might be seen to be picking holes, they're small holes in an overall very good piece of work. I'm just a stickler for trying to get it right. So I'm leaving something on the table this week with a slightly shorter supplement, but I am going to lay out a few teasers just now of where I'm at for 2025's market. Let's start with house prices, up 3.75%. I'm going precise so I have my own memorable number. Why? Well, inflation will be up in the 3-ish range and do quite a bit of the lifting. The stamp bump will even out over the course of the year. Rates should come down a little since we're currently out of what I believe to be a realistic range at the moment, so that'll add a little as well. And wages will be likely above this 3.75 range in terms of where they move over the next 12 months. Base rate at the end of 2025, 4.25%. That's my stab, and I'm sticking with it. There are plenty of reasons to hold at the moment, even if we do have a cut in Feb, as we would expect. It will start to look very fine, in my view, when we get down to that 4.25. Once again, I'd be delighted to be wrong and be being too miserable here, but if you can't cope at 4.25 to 4.75 before margin, you're in the wrong game, as I've said before. Don't rule out rates going up. There's most certainly a world where that does happen, even if we did do 2 cuts in relatively close proximity. Rents, I think, up 7%. That's where I'm sticking. ONS numbers, there's limited respite other than affordability ceilings in my view. Remember, the November number was 9.1. Growth, 1%. That's where I think we'll see in real terms, roughly bullish-ish near-term forecasts are saying sort of 2% and above from places like the OBR. That was before seeing the budget in reality. But why? Well, the private sector's sulking, waiting and seeing, and is very nervous about investment rather than just cut and run as a strategy. Multinationals will no doubt thrive, as will the public sector, and that will keep the motor moving forward just about, as will our resilient services sector, as long as that also continues to grow its exports. Inflation, 3.1. I'm going for a precise number again. That's where I see 2025's average with a bit of fuss when we get the first print back above 3%. Once that's out of the way, there should be a bit of calm. 5-year fixed rate mortgage rate, range of 5.5 up to 6.25. I'm talking limited company, buy to let, no fee when I say that. If I saw some 5.5 no fee, I'd be taking it very quickly on anything that I was waiting on remortgaging if I was waiting. Keep checking and checking again as they go down. That's limited company rates, as I've said. Yields, well, if that's all correct, they'll continue to increase on residential by definition. In commercial, I'm still concerned that the normalisation of zero interest rates has not yet taken full effect, and so there could be continued yield expansion to be considered on the commercial property side of things. That's a very broad comment, and it might not apply to all niches of commercial property, but I'm going to leave it as a general viewpoint and have it as a take care shout rather than a specific or prescriptive view. So, just one more reminder then before we hear the bell toll for the new year. Tickets for the next Property Business Workshop are still on sale. Thursday, Jan 16th, 2025. Fantastic subject matter. How to plan for the year. Your efficiencies and being more efficient in your day-to-day operations. And then financial accounting and bookkeeping. No, it's not going to be a room of people learning how to use Xero or Sage or QuickBooks or whatever. Other software is available, of course, but it's how to ensure reporting is set up correctly and then how to monitor it on an effective, ongoing monthly basis. Come along and also get your strategic planning sorted out, and your January kick up the backside comes as part of the package as well. Get your Christmas present to yourself. Early bird tickets only around for a few more days. Genuine 10% face value discount. Once they're gone, they're gone. These events do sell out, and Rod and I would love to see you there. So bit.ly/PBWFIVE. And we all know there's only going to be one way to deal with all of this ongoing noise and excitement in 2025. Keep calm, always listen to the supplement, and carry on. Thank you.